checking in those bags, shopping when we land. Big FN bag of ballin'. Plead the fifth if I get caught, they talk. Came through dripping on them, I been saucing.
In this section, I will be going over candlestick theory. So last section, I went over candle range theory, which is essentially talking about the wick closure and body closure of candles and how we can anticipate as well the direction of the next candle based on how it closes, based on the previous candle, right? So now we are going to be moving on to candlestick theory, which is talking about how candles develop in the market, how the algorithm generates and creates these candles. Okay, so let's just start off with the high time frame daily. A lot easier to see. I'm just going to group all this together so it's easier to see as well. So candlestick theory is essentially open high low close and open low high close. So let's write this down real quick. Open high low close and open low high close. This is for one is for bearish and other one's for bullish. So for example, let's say we are anticipating price to go up. How this next candle prints is based on open high low close and open low high close. Open low high close, I should put this, I'll put it on the bottom. Bullish candles. Open high low close is bearish candles. Not necessarily the candle itself, but bearish, how should I say it? Bearish delivery. I think that's a better word. So open high low close is bearish delivery. Open low high close is typical candlestick bullish delivery. So every single candle, again, market is fractal. This happens in every single time frame, it doesn't matter. Majority of candles, if you guys have not noticed, have wicks on both sides. Wicks on both sides of the body. Very few candles in the market you will see on any time frame have no wicks at all. You guys see almost every single candle has wicks on both sides, and very rarely will you see candles with only one wick on one side, meaning there's only one wick and the other side has no wick. Even here, you see the tiny wick above, tiny wick above. Okay, very rarely will you see a full-on candle with one wick on one side. You see how all these candles have wicks both sides. Still looking for a candle with no wicks. You guys can say this candle technically here open and had no wick on the bottom. It just has a wick up top. Same with this candle here. And usually what happens is when candles are extremely bullish or bearish, moving in one direction impulsively, like very fast price delivery, this will occur a lot more often where we don't have pullbacks. Basically on the fractal nature of the market, you guys know that I teach you guys buy to sell and sell to buy, right? So this right here would be a sell to buy. However, first off, there's no imbalance here. So this is not directly sell to buy, but in terms of fractal nature of the market, this candle on lower time frame went up, came back down, but when the next candle opened, there was no sell buy. Instead, it just bought, meaning this candle did not do a pullback fractally. This candle also did not do a pullback fractally. Usually candles will have wicks like this on both sides because there will be pullbacks to each recent candle open and close. These candles have open and close on both sides, candle wicks on both sides. These have tiny wicks on both sides. This candle here is a good example of no wicks, right? This candle has no wick, meaning this candle, when it opened time-wise, it never did a pullback. This is the closure of the previous candle here, right? What happened was price closed here and immediately shot up. There was no pullback. Price never came back to mitigate anything. It just shot up with momentum. Candles majority times will follow open high low close and open low high close. Now what does this mean? Let's first go over the bearish delivery first. Open high low close is bearish delivery. Open high low close is bearish delivery. What does that mean? So the open, you guys should know by now how to mark the open high low close of each candle. If not, show you guys real quick. The open of this candle, or the close of this candle, is right here because price stopped there. The open of the candle, first off, is the closure of the previous candle. So this candle body right here, on the bullish candle here, this was where it closed. Now, where the previous candle closed is where the next candle will open. So this bearish candle here, its opening price is right here. Now, where's the high? The high is here, the wick. The wicks are high. So if I really need to, I'll do it this way. Open. This should be pretty easy, but open, high, low, close. Open, high, low, close. Same thing repeats for the next candle. So open, high, low, close is bearish delivery. Open, low, high, close is bullish delivery. So right here, you guys can see essentially what happens is this candle opened up here. It created a high, which is the wick, and then it came back down. It doesn't necessarily go in this order, but typically majority of times it will go in this order. It made the high, wick, and then it made the low, and then price made a pullback and closed. So fractally, this is what's going on the lower time frame. Open price, high, low. This is not good because of how price is magnetizing right now, but low, and then close is right below in the situation to open. So open, price went up, high, made the low, close. Vice versa for bullish. So now that we know this, every single candle will close like, well, if it's bearish, we'll do this. So this candle right here, open here. This is the open, this is the high, this is the low, this is the close, right? It just repeats itself in this order. So right here, next candle right here, bearish, right? We were expecting bearish delivery because of context. Open, high, low, close. Just keep practicing, and with your eyes, you will be able to see this repeat itself. Now, what does this mean is when this candle closes right here at Wednesday, 22nd, May 24th, 2024, price did a pullback fractally first to make this high. And why does price do this? Why does price typically create the high first? Well, it's because price, in order to go back down, remember, price is never gonna shoot straight down. The price never shoots straight down. Price has to always do mitigation, continue going down. Therefore, this right here is literally mitigation, okay? A pullback mitigation. Price opened, came back up to mitigate, meaning it came back up to either tap into some sort of supply, okay, miniature supply, and then created the new move down to take out the previous low here. So all these candles you'll see will repeat themselves if it's bearish. So for example, let's find this candle right here. It opened up, hit a high, hit a low, and then it closed here. That's typically the order. So if we are on the lower time frame, if we can mark out our open, high, low, close, we can anticipate price, right? So if we mark out our open price, we can anticipate that above, if we are bearish, we want to be selling above the opening price and targeting the previous daily low. I mainly use this concept for like applicable to my trading. I'm going to use it on the daily time frame because you don't want to be using this concept on the 15-minute, for example, unless this fits in your trading plan, because the 15-minute open, high, low, close, it's really hard to keep track of because it happens so fast. And I find it just not applicable to my trading. So I mainly focus on the daily for open, high, low, close. As you see, same thing occurs here, right? On the 15-minute price, open here, talking about this candle right here, and then it made a low to mitigate, lower time frame, made a high, the wick, and then close. So that's open, high, open, low, high, close. So remember the two orders for the two different candles. So now let's give you a quick example of another bullish example right here. Again, all this needs context, right? But if we're bullish, opening price is here, low is here, creates the high, which is the wick, close, which is the body. So open, close is the body, high and low are the wicks. So again, like what I said, if we use this, how can we apply this to our trading? Mark out the opening price of the daily candle. What does that mean during a session? When we are looking to, if we're looking for bullish price action, we want to be buying below this low because most likely below this open, actually this open price right here, because most likely price will create this open, low, and then high close. It will very unlikely, it's very, very rare for price to just open up and then create the new high, right? So we can always anticipate some sort of pullback as soon as the new daily candle opens. This is what I call the daily open. You can call it the new daily open, whatever you want to call it, new daily open. Okay. So on the lower time frame, if you want to go back in time, I'll show you guys how you can apply this real quick. This is the daily open, right? 6 o'clock p.m. For me, this is the daily candle open. This right here is the opening on a lower time frame of the daily candle. This is where it opens. So what does that mean? First off, we don't need to stretch it this far. It's way too far. I just know it's here. I think it was here. This is the new daily open. Now, what does that mean? We want to be buying, if we're bullish, we want to be buying below this new daily open. So let's say we're on the chart right here. This is 8 session. Okay. 8 session is here, 9 o'clock. This would, where if I would trade, I would trade 8 session here. I would already notice, well, this is the opening candle, the daily candle. We want to time our trades. This is where time theory comes involved in trading. Time and price is also very important. You want to add it to your trading plan. Okay. You don't want to add too many things to your trading plan to confuse yourself. If it doesn't confuse you, feel free to add it. If this confuses you too much, feels like doing too much, don't add it. Just because you don't want your trading to be too complicated. You want to make your complicated things as simple as possible. Yes, things that at first that seem complicated will become easy. That's why the more you practice things like this, like understanding time cycles and understand how time works with price, you will find it to be super easy later on, and you don't even think about it. And so you don't find it confusing or complicated. That's why practice in screen time is super important. Experience seeing this play out live is extremely important. Seeing it play out in backtesting helps you build the confidence, but seeing it play out live actually helps you truly understand your system and have the confidence to execute it live, right? So this is the new daily open, okay? What does that mean? We want to be buying below this because if you want to think of it like this candle is right here, right? We're actually literally right now, this is the body of the daily, for example. We are literally right now creating the wick. This right here is creating the wick of the daily candle. Isn't that crazy? This is literally how fractally the market works. This is literally all this price action is creating the wick of this candle, daily candle. So we want to be buying below new daily open. So right here, for example, we have an OB right here, and then this OB gave us confirmation here. We had an internal break of structure, change of character. But here, for example, this could be a valid trade. We were below new daily open, so in terms of timing, our trade is very good. Now, what do we target? Well, first of all, I can use my eyes and already see it, but we can draw it here if you guys want. We target a previous daily candle high, or we target another obvious high, which is that. That's the extreme high. So where's the candle trade? This is the extreme daily high. Now, here's the thing. You don't want to be targeting too far, right? This would be too far. Yes, price does run there, but you hit your stop loss. Oh, no, you don't. You don't hit your stop loss here in this situation. But it was very close, right? Very close to break even at least. But you don't want to be aiming too far away. This is the previous daily high, I know based on time, right? You guys see it fractally that this is the previous daily high. You would have had a bagged 7-hour trade here, which is great. And this also helps you prevent you from taking losses in case you're taking any type of confirmation trade here. You can see there's always confirmation in the market, right? But there's not as much anticipation. Indicators will never give you anticipation of price. This is a skill you definitely master with experience. So you guys can see you can avoid taking a loss there and you target this as liquidity. Boom, 7R right there. Now, if you want to target that daily high that was shown earlier, you would have gone in a 37-hour trade. And how long? 11 hours. 11 hours to get 37 hours is absurd. I don't think people understand how much profit that is. 37R in 11 hours is like unbeatable, right? It's insane. Usually, even 100R, like I do every month, is top 0.1%, I'd say, probably of traders, right? Most traders advocate for 10R a month, which is roughly 10% if you're risking 1% per R, which 10% a month is good, right? But for us as day traders, I would expect us to at least make 20R a month. That's a good indicator and milestone, I would say. Start with 20R a month as a goal, or even in fact, start with 10R a month, or start with break even a month. For people that are unprofitable, start with break even, work your way to 10R, then 20R, then keep increasing it as you get better, and you will later realize you can hit these insane trades. This is 37-hour risk reward trade using time theory, candlestick theory. So this is extremely crazy. Open high, low close, open low, high close is extremely crucial, right? So for example, here, let's say we can choose this example here as well. We have another example of bullish price action here. This is the opening price of the previous this candle now at 6. Look what happens. Price, this is creating the wick. After this, after 6 o'clock, this is creating the wick of literally the daily candle. So this price action low time frame is creating the wick of the daily candle. And we want to be buying the wick. Okay. We want to be buying the wick creation with confirmation. So then we take something like this. Maybe we can take a trade here later. And then we target something, I don't know, wherever you want to target. This runs quite a lot, I'd say at least. This is where you can use time theory in price, align it together, and catch some insane trades. So again, this is how we basically are able to view the market factually on the lower time frame while staying on the higher time frame. Some crazy, insane thing. Definitely want to be testing this out yourselves, guys. And, I personally don't target those 50R trades, but if you want, you can literally create a system off of literally timing your trades off the daily candle or maybe a 4-hour candle, anything you want to use for this open high, low close, and open low, high close. I might make a part 2 to see if I cover anything new that I missed in this video, but that's literally the basic concept of this and is extremely, extremely important. You guys understand time and price delivery in the market. You don't have to have diamond price delivery alignment to be profitable. Okay, when I was backtesting, I did not use any of this time and price delivery alignment, and I was already making very good profits from backtesting and forward testing and live trading. But if you incorporate this into your trading and see it play out every single day, you will build more confidence and take potentially better setups and high quality setups with higher win rates and better risk reward. So, again, that's it for this section, and I'll see you guys in the next one.